Hi, how's it going? Today I am going to discuss the implications of a bear market, similarities between previous bear markets, and the possibility of one developing now. I only say this as we've dropped 14.25% on the NASDAQ in 4 weeks, which is a lot due to this current administration's economic policies and the trade war we are conducting. There's a extreme possibility that the next GDP, or next quarters, or the next GDP report of the quarter growth is negative. Models are saying that we might see a minus 2.3% GDP growth just because this trade war is going on. Not because of anything else, just because this trade war is beginning for no reason. There's also a pretty good possibility the quarter after is also negative growth if this trade war continues to happen. If so, there is a possibility of a recession. It's not the I guess it's not a generally agreed upon term. Usually you don't realize that you're in a recession until you're far into the recession, but two straight quarters of negative GDP growth are common, but not an official indicator of a recession. So this is important to know, as this affects your day trading. It affects your long-term bias, and it affects your personal life, how much you can spend, how much you can invest, how much you should stay out of the market, or anything else when it comes to money or your job. So it's important to know this. But let's begin. This is going to be off the top of my head. Unlike my previous video where I did the research ahead of time, this is going to be me looking at this and viewing it and evaluating and measuring on a weekly time frame. So it might not be the cleanest and most efficient, but if you're watching me, then you're not expecting that. So, all right. Anyways, let's start. It's important to know and measure where we are. OT is a good way to understand this. This specific leg up, which is from August lows to December highs of 2024, we can see we hit OTE. We bounced off well, but if this trade war continues to go, I do not expect this to hold. Therefore, we could look at a higher time frame. Something more like this or this. But what I'm interested is this. The entire leg up after our 2022 pullback, which we will study. But just to show how far we have to go, there's a 37% pullback to get to OTE. Well, I guess to get to OTE, it's to get to 6.2. That'd be 32. To get to the 705, which is below the sell side right here, which would be a great target if we ever got here. That's a pretty good pullback. 37%. Which it could happen. We've already fallen 14% in 2 weeks. Or 4 weeks, I should say. And this current administration continues these fiscal policies. It would not be surprising to see something like this. But the only reason why I say this is because I want to compare it to this. Let's compare this to this. Same idea, right? This is a leg. This is a leg down. Jeez. So you go down, up, right? Right here. We could put it here too, if you really wanted to. This looks pretty similar to this. I will get rid of this, just for clarity's sake. So this is a 14% pullback. These are very similar. Here's a 14% pullback on this. 18. This leg was 37% up. This leg was 28. So you can see, pulls back about, again, 62% of the way, 79% of the way. 62 to 79% of this leg, which is what the OTE is important. Obviously, well, right now, if we compare it to this is where we're at in 22. If you zoom in like right here, let's get rid of this for clarity's sake. Let's get rid of this for clarity's sake. This is what we saw. That we saw pull back up to sweep by a side, and then a continuation down. Right? This is what we're looking at with this specific OTEs, is the short-term OTE comparatively to this. We have a fair value gap open, not formed, but open at this point. What's important to also note is that this meandered around, same as this. Let's do a date range between this candle, 4 bars, same idea. It took 4 bars from here to get down to OTE. It took 4 bars from here to get down. So it's similar. A move down like this isn't necessarily unprecedented, but the ferocity that it went down is scary. Again, moves down like this are not unprecedented. They have happened. They will continue to happen. It's just how fast they go. As you can see, this one formed an order block and then went down. We had no such thing here. And even this one went down and then went right back up, forming a doji. This one did no such thing. But it's important to notice these similarities and to notice how this OTE eventually got blown through. Went down and then went back up, went back into this form fair value gap right here, which ended up being somewhat useful in the future. But anyways, go back up and then we went back down, which is important because this this OTE wasn't the ultimate OTE that we were looking at as a potential bottom of the market. As same with this one for myself with this current pullback. I do not expect this one to be the bottom OTE. I do not expect us to make a 14% pullback and then go all the way back up to new highs. These tariffs do not just go away overnight. The effect they've had on American reputation with our allies is unforgivable by our closest ally. I mean, it makes sense. They don't trust us as long as this current administration is in power. And as long as they are in power, these mistakes will continue to be done at the cost of American people's wallets, jobs, and retirement portfolios. Anyways, let's study this. Now, what do we see here? I'm going to extend this over. Put it right up back over here. May not be the I'll put it to the exact. I don't want to get this exact. It's important to get good data. The high of this is 76750. 1 second. There it is. So, anyways. Now, we look at this OTE. This is the same idea. 2020 lows, 2021 highs. This is the pandemic boom. Was it a good time to buy stocks in this? Very good time. Money printers galore. Inflation coming up, baby. Very good time to buy stocks. 152% rally from our lows. Just to see, again, a 37% pullback. To where? OTE. Very, very, very close to the OTE. So close that I won't say that it touched the 6.2 because that is too close to say it didn't. Anyways, we went down to OTE, but obviously this market on a high time frame monthly basis is an extremely strong bull market. We see this type of price action. Put this if you didn't see the weekly up here or up or right here, and you put this or without all this date, whatever, you put this on the same chart on the 1 minute. This looks like a damn good play, right? And this is something you see in a very strong bull market. So it makes sense. This was a very strong bull market with just a little bit of a bear market when inflation started going out of control. But this is what I was saying in my previous video about FOMC and why it's so important that a soft landing is had. Soft landing is without any sort of significant economic displacement or shrinkage, compared to a hard landing, which is just bluntly a recession based off of constricting the economy, which is what they've been doing to corral in inflation. Very strong bull market. We went right off of this. So it's important to know that this high time frame OTE was respected, as we were in a very strong bull market with a little intermittent bear market once inflation went through. But by the end of 2022, which 2022 was a very down year, we ended up going all the way back up. Right? We made all new highs. And from those pandemic lows, we went up 238%. So now, let us compare. From these lows to this high, we doubled. The market more than doubled. Perfect. You bought down here in this OTE, which could have been done. Easily could have been done. If you apply the same model number one, that you do on 5 minute, 15 minute, 1 hour, daily, doesn't matter. Same thing. This is a monthly time frame. You could have timed this bottom. But I digress. Anyways, 113%, a solid growth up. Now, let us do this. Here is the same OTE on our 2022 to 2024 bull run. It's important to know the possibility of it repeating like it did in 22. Again, a 32% pullback, a little bit less, but look at that. That once wondrous fair value gap could be abused again. Maybe we go down in here, right? But this is what you'd be modeling after if you're long-term bearish. If you're thinking that we're going to go into a pullback or a recession, OTE is a good way to model. It's the idea that market structure will hold and not make new lows, but we get a good enough pullback. Right, that's what OTE is, and this is why we love OTE. It's the idea that market structure is going to hold. So that is important to know. Even at its worst, it's a 40% pullback, which is a rough pullback, that's entering recession territory of level of NASDAQ pullback. Because this wasn't a recession. You could maybe call it a recession in 22, but the job market bounced back and we did good. That was more of a bear market rather than a recession. Some indicators might say it was a recession, but you ask anybody, they're not going to think 2022 was a recession and compare it to 2008. It was not the same thing. We saw extremely fast bounce back of just obviously the stock market and everything, right? It took less than a year, or just about a year. Let's see. Yes, a little bit more than a year to get back to the previous highs, which isn't too bad. But anyways, let's examine 2018. It's funny because you look at it, you're like, wow, this whole pullback was little. It was so little. Well, that's just because the prices have gotten higher of the thing. See, 24%. 2018 trade war, we look back at it. It was an increase of prices like we are seeing now. And we saw a 24% pullback. I'll put this up again. 24.69. That would be a pullback to just about here, which would make sense if we got down here. See, the difference between that trade war and this trade war, and that trade war was with China. We are not necessarily the friendliest with China. I mean, there are direct competitors for many, many things. This trade war is with our closest allies. We are violating the North American trade agreement, which was a marvel of friendliness and ease of trade with your direct neighbors. And now that's gone because of whatever you want to call it. But nonetheless, this is why I think this will be worse than this. But it's still important to understand. So we're going to look at it. Zoom, zoom, zoom. See? Back when prices were at $6,000 compared to the 20 grand we're at now. But eventually it'll be at 50 grand and we'll be looking at it like, wow, remember when it was 20 grand? Anyways. Let's examine this trade war right here. 1, 2, 3, 4. About the same. A little bit less, but about the same. In a 4-week span. The current one was more aggressive than this one. And we saw a buy-side sweep right before we went down. Then we meandered a little bit, and then we made our final fall. Now. You could do something like this. This is a 2-year fib. And it goes right down just above equilibrium. If you want to be more niche, I guess you could do something like, oh, it went down to OT here or here. You know, went through OT here. But if we're going to extrapolate the same rules that we gave this, this was a good down leg to take the rules here. The last trade war's pullback was not too significant. It was a pullback. Possibly you could call it even a bear market. But lasted 84 days. And how long did it take to get all the way back up? 119 days. Well, I guess maybe 112, but specifics are, I guess it goes up by 7-day increments. Just due to it being in a weekly chart, but besides the point. We saw a rapid V-shaped recovery and then just continuation. This was in the last Trump administration, the first Trump administration. But now, we'll go look at the Big Daddy. Again, you look at, 2008 looks so little. Livelihoods were absolutely destroyed in 2008, which I have an entire breakdown of the events in 2008 on a different chart. I gotta find it, but for now, we're just gonna go here. Let's see how many days it took to get from there to there. A year. How far did we pull back in 2008? The last actual recession, the Great Recession, in fact. 54%, which is insane. Imagine that. Over half of the value of your assets just disappearing in a year. Half your 401k, and you saved up $1 million. You're about to retire. 2008 hits, now you have $500,000 to your name, just in a year, because of a recession. You can't retire anymore. That's not enough money. $500,000 to live off for the next 20 years. $1 million might have been. $500,000, not so much. This is why recessions are scary. You put it in that point of view. Not to mention the jobs that were lost and the inability for some families to... Well, this was a real estate crisis, right? You know, people might say we're in a real estate bubble now. This was a true real estate bubble with investment banks taking extremely risky bets on the real estate market. That was a bubble. We're not in a real estate bubble now. We're in just rapid growth due to inflation. What are the similarities between now, well, then's Great Recession and the possibility of this current recession? Well, this one again wasn't sent off of real estate prices and the bubble of the ballooning value of assets. This recession, possibility, again, it's early. We don't know if this is recession or not, but the possibility is inflation. Inflation is reintroduced, and we go up to over 7.5%, like we saw earlier in 2022 in that last big pullback, and we go above that, and goods are way more expensive, and these tariffs are not pushed back. See, the thing is, this recession can be avoided if these tariffs go away. That's the difference between 2008 and now. If these tariffs go away, we'll see a pullback, yes, but it'll be something more similar to like what we saw in the 2018 trade war. Inflation might spike a little bit, but these tariffs go away, and the effects might last a year, and it might be a little bit rough, but we'll be able to get on our feet again, as compared to 2008, where it was irreversible. This damage could not have been prevented past the point, which I guess saying irreversible damage past the point. Same idea with these tariffs. If these tariffs stay in place for long enough, they will cause irreparable damage, and we will be in a very poor position with inflation. I guess irreparable damage in a short to medium time frame. Eventually, everything gets healed. Look at 2008. Real estate nowadays looks... 2008 real estate looks like a bargain compared to now, even at its peaks. But still, it's important to understand that, even in this technical analysis. But here. But you can see that 2008 was a little bit different. I mean, fair value gaps back then still work, because guess what? Price action doesn't change. It's the same idea. Well, look at that. I did a whole thing on this too. Look at that fair value gap. That's the short of the lifetime right there. That's a short of a lifetime. It's important to understand this stuff. Even over here, look at that weekly. Look at that. You short at that CE. I mean, back then, fair value gap wasn't a known term. You short at that CE, you literally, obviously, made a lot of money at the expense of millions of Americans and people worldwide. But you do what you got to do for your family and yourself to stay afloat and put food on the table. And if that means shorting the stock market, so be it. Anyways, it's important to compare this, because this drop was 8%. From the highs to down here, there's a 12% drop in 3 weeks, which we saw a 14% drop in 4 weeks. But we recovered quick because we didn't realize how bad it was over here. Right here, when we go down, a 22% pullback. But going up here is 23. This is what we call a dead cat bounce. This right here is the definition of a dead cat bounce. And we can see what this means. Even if you want to extrapolate it up here, it still goes into OTE, right? Dead cat bounce is just a pullback up into OTE before the real blood happens. Even if you want to say this one, look at that. Boom. OTE stands firm back in 2008. It stands firm now. It's the idea that market structure holds. As long as market structure is a thing, OTE will stand firm as a concept. But it is important to understand this. I'm pretty sure I put it on the DJI. Or it might have been on my other account. Oh, jeez. Where's the SPI? I think it was the Dow. It was the Dow, and it was on a different account. Damn shame, because I did a lot of work on that. I marked candle by candle what happened in the 2008 recession. I gotta find screenshots of that because I did do it. I might have pinned it in the Discord, but I did do that. Anyways, a lot of it in 2008, I guess I'm just gonna go back just to show because it's important to understand that this recession is truly. I mean, look at 2000. It was crazy. Look at the peaks of 2000. This is the dot-com bubble. This was bad. And NASDAQ. Sometimes you don't realize it. Now that is a pullback right there. The dot-com bubble will never see growth so quick, so fast than the introduction of the internet. AI doesn't mean nothing compared to this. 363%. No, I guess you could say. Nope, not even close. And I misjudged the bottom of this. Not even close. The dot-com bubble was like nothing you've ever seen. This was a tech bubble, and this was insane. This isn't something that you're going to see, hopefully, ever again. I mean, again, this is the growth of the internet. Imagine being alive in 1998, 1999, and hearing this internet thing and be like, what is that? And all of a sudden taking over everything and just revolutionizing. This is the bubble. And then just the collapse of that. And the fact that '08, at least on the NASDAQ, didn't even come close to what 2004 was. And if you invested right here, you didn't hit that level again until 2016 is ridiculous. Okay, if we do one at the Dow, it's going to be a little bit differently because it's the Dow, but I don't invest in the Dow. Right? The Dow is different. I would say the Dow is better to understand the general consensus of the market, or maybe even the SPX. But see, again, 2000, went in and making new highs in '08, right? But tech is different. I day trade tech, so I'm just trying to understand it. But anyways, same thing with SPX. Let's go look at SPX, S&P 500 index. S&P 500, which has tech companies, has a weight of it. Again, we just look at this quote unquote double top. Crazy. Recession 1, recession 2, right here. Boom. Very important. It's important to understand this stuff and be able to look back at it. It's important to learn from history, even if the price action isn't the same. The fundamentals and just understanding what they look like and how it affected people. It's important. And why throwing the recession word around willy-nilly is it's just something that happens a lot. People want to claim when the next recession is because they want to be the ones who said they did it. But economists, that's what I'm working for. Economists have correctly said there will be a recession in the last 4 out of 16 recessions or whatever. It's a bad joke. Because they all claim that recession is going to happen. We don't know. There is a potential possibility, again, if inflation spikes, that this would become a recession. But it's important to understand the difference of a recession and a general pullback. And not getting caught up in the hype until it actually happens. Until the indicators show you that a recession is happening and that inflation is getting out of control again and GDP growth is getting to a point where it's too far down compared to where it was. Do not buy into the word recession. Do not fearmonger. But until that point happens, still stay cautious and safe. It's important to understand. Anyways. Longer video there. We'll see what happens. I will make an update video probably a couple months just to see where the hell we are at. Hopefully we're not down freaking here. But honestly, down here, as discussed, it's a good chance of happening. Alright. Thanks for watching if you made it through. Good night.